The Federal Reserve is sitting on $36 trillion in national debt, and they have exactly two options. They can cut interest rates, which would pump inflation and send gold to prices most analysts are afraid to say out loud. Or they can raise rates, which would trigger a debt spiral on that 36 trillion that forces money printing on a scale that would also send gold to prices most analysts are afraid to say out loud. Either way, gold wins, but here is the piece of data nobody is talking about that changes everything about the timing. There is a specific refinancing cliff in Q3 of 2026 where $8 trillion of that national debt matures and needs to be rolled over at current or higher interest rates. And that cliff is closer than you think. Let me show you the specific vault number that triggered this analysis. COMEX registered gold inventories just dropped to their lowest level since the pandemic. That means the physical gold backing paper contracts on the futures market is thinning. And when you combine that vault drawdown with what we know about the Fed's debt refinancing timeline, you get a setup that the mainstream financial media is completely ignoring. But before I get into the mechanism, I want to make sure you understand the stakes for your own stack, because this directly affects every ounce you are holding right now. Gold just hit a new all-time high. Silver is down 15% over the same period. If you are a gold holder, you are feeling great right now. If you are a silver stacker who has been watching silver crash while gold rallies, you are probably confused and maybe worried. I want to address both of those situations because the underlying mechanism driving this divergence is the same mechanism that is going to resolve it. And understanding it now gives you a significant advantage over 90% of retail precious metals holders who are just watching price charts and wondering what is happening. The Federal Reserve's dilemma has been building for 3 years. After the pandemic era money printing created the worst inflation in 40 years, the Fed aggressively raised interest rates from near zero to over 5%. That move successfully brought inflation down from over 9% to approximately 3%. Mission accomplished, right? Not exactly. Here is what that rate hiking cycle did to the national debt situation. In 2021, when rates were near zero, the US government was rolling over its debt at an average interest rate of approximately 1.5%. At $30 trillion in debt, that was roughly $450 billion in annual interest payments. By 2026, with rates elevated and the debt now at $36 trillion, the average interest rate on outstanding debt has climbed to approximately 3.8%. That means annual interest payments have roughly tripled to somewhere around $1.4 trillion. And that is before we get to the Q3 2026 refinancing cliff. Here is what the Q3 2026 cliff actually means in practice. The United States Treasury has a large portion of its existing debt concentrated in shorter duration bonds, 2-year and 5-year notes, that were issued during the low-rate era of 2020 and 2021, when locking in long duration at low rates was not prioritized. Those bonds are now maturing, and when they mature, they need to be refinanced at current market rates. $8 trillion of debt maturing in a concentrated window means the Treasury is going to be issuing enormous volumes of new bonds in Q3. If the Fed is still holding rates elevated at that point, the refinancing cost jumps dramatically. If the Fed cuts rates to reduce the refinancing burden, inflation reaccelerates. This is the trap, and the escape route in both scenarios runs directly through precious metals. Let me show you exactly why gold benefits regardless of which path the Fed chooses. Scenario 1, the Fed cuts rates ahead of the Q3 refinancing cliff to reduce interest costs on that $8 trillion in maturing debt. Rate cuts reduce the opportunity cost of holding gold and silver, which carry no yield. When bonds pay 4%, holding gold seems expensive in comparison. When bonds pay 1%, gold's zero yield is competitive. This is the primary driver of gold's historic correlation with real interest rates, the correlation that has been breaking down recently because of the second scenario. Scenario 2, the Fed holds rates elevated or even raises them further to fight inflation that refuses to fully capitulate back to 2%. At elevated rates, the annual interest burden on $36 trillion continues to grow. At some point, and most serious fixed income analysts believe that point is within the next 12 to 18 months, the debt service burden becomes unsustainable without either a significant increase in tax revenue, a dramatic cut in government spending, or a return to money printing. Of those three options, history shows that democracies overwhelmingly choose option 3 when the pain gets severe enough. Money printing at the scale required to service $36 trillion in debt at 4% interest is extremely bullish for hard assets, and specifically for gold, which has been the primary store of value during every major currency debasement event in recorded history. Now, here is the piece that connects back to silver and why the current gold-silver divergence is actually a buying opportunity signal rather than a bearish indicator for silver. Gold and silver typically move together as monetary metals. When gold is rising due to monetary concerns, inflation fears, debt concerns, currency debasement, silver should follow. The current divergence where gold is hitting all-time highs while silver is down 15% is explained by one specific factor: industrial demand weakness. Silver is both a monetary metal and an industrial metal. Approximately 55% of silver demand comes from industrial applications, electronics, solar panels, medical devices, electric vehicle components. When global industrial production slows, silver demand falls even when monetary demand for precious metals is rising. That is exactly the environment we are in right now. But here is what that means for forward-looking silver positioning. When the Fed's debt trap forces a resolution, either through rate cuts that stimulate economic activity and industrial demand, or through money printing that devalues the dollar and makes silver's monetary value dominant, silver catches up rapidly. The gold-silver ratio is currently at approximately 100 to 1. Silver is historically cheap relative to gold by this measure. The mean reversion when both monetary conditions and industrial conditions align could be dramatic. For silver stackers watching this divergence, the data is telling you that you are early, not wrong. Let me be specific about what the vault data is showing and why it matters. COMEX registered gold inventories, the physical gold that can be delivered against futures contracts, have been declining for 14 consecutive weeks. Simultaneously, LBMA vault data shows that London's gold lending market is tightening. Central bank gold purchases set a new record in 2025, with over 1,100 tons purchased in a single year. That is not a coincidence. Central banks, which are the largest and most sophisticated gold market participants, have been buying physical gold at record rates for 3 consecutive years. They are not buying paper gold. They are buying the physical metal and taking delivery. When the institutions that manage national currencies are moving aggressively into physical gold, it is worth asking yourself what they know about fiat currency dynamics that has not yet been communicated to the retail market. Now, let me address the scenario that the bears are pointing to, because I think it is important to take the counter-argument seriously. The bear case for gold and silver here is that the Fed manages a soft landing, inflation falls cleanly to 2%, the economy grows steadily, the debt is managed through strong tax revenues, and rates are cut gradually in a way that supports both the bond market and economic growth without triggering inflation. In that scenario, gold might consolidate or even pull back from all-time highs. I want to be honest with you, that scenario is possible, but the probability weighting matters. The track record of central banks executing perfect soft landings against this backdrop of debt is not encouraging. Japan attempted this in the 1990s and entered a deflationary trap that lasted decades. The European Central Bank faced similar dynamics post-European debt crisis, and the US debt situation in 2026 is substantially larger relative to GDP than any prior episode. The probability-weighted outcome across all scenarios, including the soft landing case, is one where holding physical gold and silver is a rational hedge against tail risk that has outsized upside if the tail risk scenario materializes. So what does this mean for your stack specifically? Let me give you some concrete numbers to anchor your thinking. Gold at current prices of approximately $3,200 per ounce If gold reprices to $5,000, which multiple major bank price targets, including JP Morgan and Goldman Sachs, have published as a 12 to 24 month target, your 100-ounce gold position goes from $320,000 to $500,000. That is a 56% return on a store of value position in a scenario where everything else in your portfolio is likely under significant stress. At the more aggressive scenario of gold reaching $8,000 as monetary debasement accelerates, a scenario that is in the published targets of several credible precious metals analysts, your 100-ounce position would be worth $800,000. For silver, the catch-up potential is even more dramatic. Silver at $30 per ounce with a normalized gold-silver ratio of 60 to 70 would imply silver at $45 to $53 per ounce. At $50 per ounce, 100 ounces of silver is $5,000, and 1,000 ounces is $50,000. None of these are guaranteed outcomes. They are the mathematical results of applying different macro scenarios to current precious metals pricing. The data is telling a coherent story. The Fed is trapped between inflation and a debt spiral. The Q3 2026 refinancing cliff makes this a timing issue rather than a theoretical risk. Central banks are buying physical gold at record rates. Silver is cheap relative to gold on a historical basis, with significant catch-up potential, and the mainstream financial media is not explaining any of this clearly to retail investors. That is your information edge. Subscribe to this channel right now because we are going to be tracking the Fed's debt refinancing situation monthly as we get closer to that Q3 cliff. Drop your gold and silver position size in the comments. I want to see how stacked this community is heading into what could be the most consequential period for precious metals in 40 years. And if this analysis helped you understand why the Fed's debt trap is the most bullish possible environment for gold and silver, hit that like button and share this with any stacker in your life who is watching the gold-silver divergence and wondering what is actually happening. They need this information. I will see you in the next one.